Hello everyone, and welcome to the NinjaTrader Ecosystem webinar room. My name is Juanita Archuleta and I work here in the NinjaTrader Denver office. We do have a very special event for you today with Brian of StockCalc. I would like to mention it is important to understand that there are substantial risks in trading commodity futures contracts and Forex. You should carefully consider whether such trading is suitable for you and will depend on your specific circumstances and financial resources. It is possible to lose all funds deposited with your broker and could even incur losses beyond these amounts. Please inquire at the following link for a full copy of the CFTC risk disclosure. Also, please remember that these webinars are not a solicitation nor a recommendation, but simply educational in nature. This presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Any brokerage-related questions should be directed to our NinjaTrader brokerage directly using the phone number that I just placed in the room or by emailing them. With new tools added nearly every day, NinjaTrader ecosystem is home to hundreds of apps and services. You can quickly and easily find the tools or services you are looking for with a simple keyword search. You'll also find information about upcoming webinars in an on-demand video archive to view event recordings using the following link. Also, if you are active on social media, we would recommend that you follow us on both Twitter and Facebook to get all things NinjaTrader ecosystem updates regularly. NinjaTrader is always free for advanced charting, strategy backtesting, and trade simulation. To ensure you are on the latest version of NinjaTrader and pick up a free live data trial, please visit the following link. And if you are just getting started with NinjaTrader, we do offer free live training on a daily basis. You can view a schedule of upcoming webinars using the following link. We are very excited for this unique event in which Brian will teach how to value a company using discounted cash flow and cooperative and adjusted book methods while presenting a live example of the StockCalc indicator. Thank you again today for your attendance, and without further ado, it is my pleasure to welcome to the room Brian. Go ahead and take it away, Brian.
Thank you very much, Juanita. I appreciate it. Excuse me, and thank you everyone for joining in. We're going to spend the next 20 minutes or so talking about fundamental valuation and the techniques that are used for fundamental valuation. Our website is StockCalc.com and our focus is fundamental valuation. I will show you a few pieces from StockCalc as well, so you'll see how we're actually doing it inside the site. And then we'll finish off with the indicator that we've built for NinjaTrader that shows the fundamental valuation that we're generating for 7,800 companies every day. So with that, I will start in. You've seen the disclaimer from NinjaTrader with Juanita. We also have a risk disclosure. I'll leave that here for a moment. Okay. So as an overview for what we're presenting today, we're going to talk about 3 different fundamental valuation methods. This is going to seem a little academic at first, but you will see how it rolls into real life as we're going through, because we'll have some live examples here as well. We're going to talk about cash flow fundamental valuation, so a discounted cash flow. We'll talk about an asset-based valuation, and we'll look at relative or comparable valuations as well too. And then we'll do a live example with that. The indicator that we built for NinjaTrader, you can see an example here. This is sitting on top of J&J, for example, Johnson & Johnson. So by valuing each of those 7,800 stocks every night, we're actually generating a valuation data point, a weighted average valuation for each of those stocks every day. And we'll get into a little more of that towards the end, but that gives you a flavor of what we're looking at here, the indicator that's been built here. Excuse me. So I'm going to do a little bit of valuation basics, the first few slides, to get us all in the same place. For those of you that have done fundamental analysis before, some of this you'll have seen before. For those of you that are new to fundamental valuation, this gives you a good grounding for it, a good basis. 2 terms that I want to start with: equity value versus enterprise value. Equity value, think the value of the stock. Enterprise value, think the value of the company. So the value of a company is the value of its debt plus the value of its equity. I'm sure most of you have heard that before. The value of the equity is the value of the common stock times the number of shares outstanding plus the preferred stock, if it exists in the capital structure, times the number of shares outstanding. We'll come back to both of these terms as we do some calculations. So why are we concerned about enterprise versus equity value? Well, we can determine either one of them directly. We can determine the value of the equity in the company, or we can determine the enterprise value of the company and calculate the equity value from that. The discount rates that we use on cash flows will differ. The equity value per share is really what we want to know. What do we think this company is worth compared to where the price that it's trading at? I'll also make a quick note the difference between book value, which is the value that's shown on the balance sheet, and market value, what we think it would sell for or what it has sold for. The discount rates that we look at when we're calculating discounted cash flows consist of a variety. So the cost of common equity or the common stock, cost of preferred stock if there's preferred stock in the capital structure, and the cost of debt in the company. Pardon me. Debt you can think of simply as the interest that's paid divided by the debt outstanding, or if you have a mortgage, the interest that you're paying on your mortgage is an example of your cost of debt. The cost of preferred you can think of as the dividend rate of preferred stock, and it's really the cost of common equity, which is one of the more difficult ones to calculate. The simplest way to think about it is what kind of a return do investors expect or want by making an investment in this stock? Again, this is all on the fundamental basis. So the approaches that we're going to look at a cash flow based valuation using a discounted cash flow sample or example, an asset based valuation where we'll look at the market value of the assets minus the liabilities, and a relative or comparable valuation where we'll look at how we value a company using comparable companies. And I'm not going to go into excessive depth on any of these. It's just to give you this is an introductory level to give you an understanding of each of these methodologies. So if we're looking at a cash flow based valuation, these are the following components that we're interested in. What will we see for future cash flows for this company? And there's different ways that people describe cash flow. Free cash flow, some use EBITDA as a proxy for cash flow. But we were looking to generate a projection of what we think the company will generate for cash flows on a go-forward basis. There's a very important component called terminal value. We project cash flow out as far as we can, and then at some point we have to make a decision on where we think the cash flows are going to level out and either stay flat, grow at a constant percentage, or even shrink at a constant percentage, which is possible as well too. So what we will do generally is try and project cash flows for the first few years and then come up with a terminal value for years, say 4 or 5 and beyond. Our discount rates we've talked about, we need to do a calculation to figure out how we're going to discount those cash flows in the future back to the present time. How much debt does the company have is important because we want to calculate the enterprise value, remove the debt, divide by number of shares outstanding to value the equity in the company. So to calculate the actual fundamental or intrinsic value of the stock. I won't get into a lot of detail here, but we do a weighted average cost of capital where we look at the common equity, the preferred equity, and the debt. And basically, we do a blending where we say let's say the company is 60% equity, 40% debt in its capital structure. We would use that in this formula to come up with the weighted average cost of capital. The way we think about that is if the company went to raise money again, what would that profile look at? How much equity would they raise? How much debt would they incur at that time or take on in order to come up with the capital that they're looking to raise? And this is really that weighted average cost of capital that we're looking for. Now I'll note we mentioned enterprise and equity value early on. The WACC, what we're calculating here, we use to value enterprise value. Cost of equity, which is one component in here for the common equity or the preferred if it's there as well, we can value the equity directly with the common equity. For our purposes, we'll just use WACC, which is the most common approach that we use here. So in the StockCalc site, for example, if you're any of the 7,800 companies that are in there, we have everything that's on New York, NASDAQ, the American Stock Exchange, Toronto, and the TSX Venture. And what we do is anytime you're running the valuation on a company, we calculate the cost of capital for that company. So here's Johnson & Johnson, for example. The Johnson & Johnson's equity, 92% of its capital structure is common equity. There's no preferred in the capital structure. And 8% of its capital structure is debt. So the KE, KD, KP that we saw in the previous slides. We've calculated the cost of equity, common equity at 8.18%, the debt at 2.37%, that's an after-tax cost, and the blended or weighted average at 7.72. So if we have cash flow projections for Johnson & Johnson and we want to discount them back to the present to come up with that pool of money that's available for J&J, then we would use the 7.72 as the calculation. If we were trying to value its equity directly, we would use 8.18. So just for Widgets Incorporated on the New York Stock Exchange as an example, let's say its cash flows are 70, 80, 90, and 100 million in the next 4 years. And after that, we think it's going to have a steady 105 at a 2% long-term growth rate. We have a discount rate or a weighted average cost of capital of 10%, again, for this example. So what we do is we actually calculate the present value of those cash flows so that we can say what are they worth in today's dollars. So the 70 million in cash flows 1 year from now would equate to $64 million today. The 100 million in cash flow 4 years from now would equate to $68 million in today's value. So we can add those up plus the calculation that we do for years 5 to essentially infinity at a 2% long-term growth rate. That's another 800 million. So you can see a lot of the value of a company is tied up in its terminal growth rate, over 800 of the 1 billion in future cash flows that we see in terms of the total cash flows, excuse me. So this is on a present value basis. So all of these cash flows on a present value basis are a little over $1 billion in enterprise value. So that's important because then what we can do is we can say we take the enterprise value, we remove the amount of debt that this company has, let's say it's 300 million. That leaves us an equity value of 781 million in our calculations in our sample here. If the company has preferred stock, and I've put some in just to show it, let's say that there's 100 million in preferred stock that's out there, that would leave 680 million in common equity for the company. If the company had 50 million shares outstanding, then we would come up with a discounted cash flow valuation for this company of $13.61 using all of this information. So I'm just going to flip back for a second just to show if we have the cash flows, these assumptions are very important, obviously. The discount rate is very important. The long-term growth rate is very important. Those are the pieces that help make up the discounted cash flow model that we're generating so that we can come up with this valuation. In StockCalc, we do this for any particular company. It's done automatically. It takes a couple of seconds, basically, to pull all that data and to do the calculations in StockCalc. So and the questions, I think we handle all the questions at the end, if I'm not mistaken. So I see a question that's popped up already. So thank you for that. The asset-based value, so that's the cash flow-based valuation. On an asset-based valuation, what we're really doing is looking at the balance sheet. I mentioned book value and market value. And ideally, we would like to update the assets and liabilities to reflect the current market conditions. So that is how we would do an adjusted book value, and we'll show a sample of that in a second. What we can also do is we can actually do a liquidation value as well, too. So if the company's under stress, for example, and we think there's a fear of bankruptcy or liquidation, we can actually update the balance sheet to see what do we think would be left over for shareholders if it went through that situation. So on the first example, the adjusted book value, let's say that in this simple balance sheet that we have 9 million in total assets. 1 million of it is current, 8 million of it is fixed on the balance sheet. But we think the market value of these assets are 800,000 and 9 million respectively, for a total market value of 9.8. So we think that the equipment is worth, equipment, buildings, whatever might be in the fixed asset categories, are worth more than what's showing on the balance sheet. On the liabilities side, we're looking at the current and non-current liabilities, so the long-term debt, the short-term debt, lines of credit, etc., whatever might be in there. And we're saying that basically the book and the market value are essentially the same. So what that means is if we look at calculating the equity, we would have $1 million in equity on the book value side, but because we've upped the market value of the fixed assets, reduced the current assets slightly, we would have $1.8 million in equity remaining on the market value side. If there were 1 million shares outstanding, our value per share would be $1 on the book value basis, would be $1.80 on a market value basis. So that is a really good way to try and have a look at what's the true value of that company. Now, for most of the companies that we look at, we don't know what the value of all the holdings of a company like Johnson & Johnson or Facebook or whatever it might be. So what we need to do is we need to use proxies, and that's where this ratio of price to book helps us, because we can take a look at a book value per share times price to book to come up with an actual market value of the company. I won't go any deeper than that at that point, but that's all explained within the site as well too. If we wanted to look at it on a liquidation basis, if we had 9.8 million in assets, there's disposition costs, there's a liquidation, so profit and loss during that period, liquidation costs, taxes. That would leave us an equity in this case remaining. If we had the 1 million shares, we would have 49 cents per share left for shareholders if this company was going through, if we thought this company was going through a liquidation process. So that's an interesting exercise to go through very quickly as well too. Finally, the third method is to compare the company on the basis of other companies like it. In the same industry, similar size, similar geography, technology, whatever it might be. And what we do is we use ratios that are standard in the industry, such as price to earnings, price to book, price to cash flows, EV, enterprise value to EBITDA. So, for example, if I was looking at Johnson & Johnson, and I took an average of the companies that were similar to it. So let's say Merck, Pfizer. I use J&J a lot because it's a really good example. Merck, Pfizer, Eli Lilly, others that are in that space. And we came up with an average price to earnings ratio of 28.13 for those companies. J&J's earnings per share, most recent, was $5.40. So if I multiply those two together, I get a value of approximately $152. J&J is trading approximately $140, I think, currently. If I look at a price to book ratio, the average comparables are significantly higher than what J&J is. J&J has a $22 book value per share. If I multiply this through, I would actually get a $400 valuation on J&J, which seems extremely high. What we actually do as well as part of this is we look at making adjustments. If this company traditionally always has its ratios higher or lower than the industry that it's in, we can actually make an adjustment. So in this case, the average that we're seeing is considerably higher than what we would normally see for J&J. So it's quite a punitive adjustment, which brings the valuation back down to 151. I didn't arbitrarily pick the minus 64. I actually calculated that over the last 10 years. How does J&J's price to book value compare to the price to book value in that industry? And it's traditionally significantly less. Conversely, its price to cash flow is a bit higher. So you can see once we've done the adjustments, we come up with a weighted average valuation here of approximately $142 on Johnson & Johnson, which is about where it's trading at right now. So that here's another example for Intel. This is an older example, but same sort of thing. Let's get the average values for the comparable companies. Multiply those ratios against their appropriate. So price to earnings ratio, we would multiply against an earnings per share to come up with a price based on comparables. I think Intel was trading about $40 at the time when I ran this. So you can see all of these different ratios are used to come up with, and we can come up with the weighted average valuation. This is a very standard technique that's used by evaluators to try and look at a company. If you think about a company that has has negative cash flows, for example, and it's a long time before you're going to see cash flows, a comparable is a good tool to use for a company like that, so that you can actually see how does it look compared to its peer group. It's a very valuable technique. And really, holistically, what we do is we will look at all of these different techniques and then sort of make a composite from that. Now, we actually do one other comparable as well, too, when the company has no earnings. So we've actually talked to some CEOs and CFOs, and they gave us some different ratios that they use. One that a lot of them use is how did their stock do over the last year compared to the group that they're in. Very common. But things like what is their net plant, property, and equipment, their net PP&E, how does that compare? How much cash do they have per share versus the comparable companies? So for the very small companies with no earnings, potentially even no revenue, we will use other models like this as a comparative basis. And then this is just a snapshot from within StockCalc to show a sample of a company. This is CMI, CCOM satellite on the Toronto Stock Exchange, and how we will come up with the valuation for it there. So I'm going to take a few minutes. I'm going to walk you through the StockCalc website to show you. So we've gone through sort of the academic process of that. In StockCalc, we run 7,800 companies every day through all of those different valuation models that you see. We actually have the algorithms built to look at 5 different valuation techniques plus analyst consensus if we have it for the companies to come up with a weighted average valuation for each of the stocks, each of those 7,800 stocks. We actually have an API built for the site as well too, and you can run any one of those stocks, and then you can do all kinds of what-if scenarios on them. What if I change the terminal growth rate? What if the cash flows are higher or lower, etc., etc. So for any particular company, we generate a couple of different types of reports. We generate a very detailed report that has all the financials, all of the ratios, all of our calculations in great detail, so that you could actually reverse engineer and see what we've done for the calculations, and then go back into StockCalc, into the site, and start to play around with, well, what if I dropped that comparable company? What would that do? What if the terminal growth rate was 3%, not 2%? What would that do? You can work through all of those, which gives you a lot of comfort around the valuation, because if you can zone in plus or minus a percentage on the valuation that you're generating, then you'll have comfort around sort of what the company is worth. We actually also run valuations on ETFs. Since we run the valuations on all of these companies, and we have the weightings how they are in the different ETFs, we just basically roll that data all up to come up with a price and valuation, or a valuation for the ETFs that are in the. We run 800 equity ETFs in the U.S. Every week as well. Our screens are built. Most financial software has screens built. Ours are built to allow you to run and add valuation into your screen. You can select for industry. You can select for analyst, buy, hold, sell. You can look at dividend rates, growth rates, earnings per share, but you can also select on the basis of valuation in our screen. Give me stocks in the screen that are fundamentally undervalued, where the discounted cash flow is greater than the price and the analyst consensus is greater than the price, for example. The beauty of this is when you put a portfolio into StockCalc, you can actually see price versus value, and you can see all of the valuation data points that we've generated. So we talked about a discounted cash flow model, we talked about a comparables model, we talked about an adjusted book model. You can see there's a couple of others plus analyst consensus in there. Our algorithms every night produce a valuation for each stock, each of the 7,800. So you can have a portfolio in here and you can see what's under or overvalued in all of the stocks in your portfolio. The beauty of it, our screening tool allows you to build portfolios on the fly, which means you can then pull those portfolios directly up in the valuation tool, and you can see the valuation for every stock. So if you're looking at an industry, for example, pull up all the stocks in a particular industry, load them into a portfolio, takes a couple of seconds to do, step over into the valuation side, run the valuation, takes another 5 seconds, and you can see a screen like this that shows you all of the different valuations that we've calculated for all of those different stocks. As I said, you can get into much more detailed analysis. So here's the discounted cash flow. You can play around with growth rates, tax rates, cash flows, all of those different pieces to say what if. What if I change those? What happens? How sensitive is the company to the following? You've seen this already. This is a shot of a comparable. So if I want to do a comparable analysis on companies, I can select or deselect stocks that I'm adding in there. I can look at the different calculations that I'm getting across the different ratios. So it can do a number of things on the comparable basis. So part of the impetus for generating the indicator for NinjaTrader was, what do our valuations look like compared to price? So this is an example of it's a small Canadian marijuana stock, actually, organogram. And you can see a snapshot here. How was our valuation versus price? And in NinjaTrader, and I'll show you this in a few minutes, This is really what you're seeing is what our valuation was at a point in time compared to the price. So this is very helpful information, with the note that fundamental analysis, fundamental valuation is really a longer-term investing strategy. So if you're looking to buy stocks because they're fundamentally undervalued, it tends to take time to reach that valuation point. It could be months, or it even could be years, truthfully. So that's part of what needs to be considered when you're looking at buying stocks on a fundamental basis. For those of you that day trade, what a fundamental value will give you is sort of a bottom, what's the worst case scenario on a stock like this, or what should I be looking at as a worst case scenario? So you could actually dig into the models and say, well, what if all of this happened? Where could this thing go fundamentally in terms of its value? As I mentioned, we have an API available as well too. That's a premium product on the site, but it allows you to access the site, access the data directly without even going into the site. Mentioned that we value ETFs. We also value industry. So we value 145 industries every week as well. So in this case here is aerospace and defense. You can see this was done back in May. Looked like they were 4.5% undervalued as an industry. So the beauty of this is you can take a look at it. If this is an industry that interests you, then all you would need to do is go into the screener, pull up all the aerospace and defense companies, run them through and get their valuations. Then you could take a look at to see which stocks would interest you perhaps. The final piece is that all 7,800 companies are valued every night across all those different models. So here's just a quick snapshot of one of the tables. So every night we add 7,800 companies to this table. What was the close price? What was our valuation? What was our cost of capital? What were all of the models that we generated? What were the valuations of all of those models? So if I had this in a portfolio, I could actually see all of this data in my portfolio in StockCalc. If you're interested in having a look at it, on the StockCalc website, at the bottom, you can actually click on the NinjaTrader logo, and that will take you to a landing page that explains the indicator that we have and provides a 7-day free trial. Now, the way we structure the free trial is it does require a credit card. The credit card does not get changed. You can cancel any time. But as soon as you register, you will get an email with the indicator. And in order to register, you will need your NinjaTrader machine ID. That's required in order to do the registration. That way we will know that your, there we go. Thank you. StockCalc NinjaTrader.html. So as I mentioned, the indicator actually shows right on the, we have it on the NinjaTrader site. So what I will do is I will move to the screen sharing, and I believe this should be live. So maybe Juanita, can you confirm that this is live? Oh, okay. I have someone else here that's with me. So yes, it is live. So here's an example, AAOI, I think Applied Optoelectronics. Here's an example of the monthly. So I pulled up the price chart and I pulled up the StockCalc valuation. First of the month is what it grabs. I can grab this on a daily or a weekly basis as well too. Now, this is interesting. When we look back, I'm in 2015 here. Our data starts in 2013 for the monthly in some cases, in most cases. Sometimes it's a little later. But here you were seeing our valuation was holding above the price for a period of time, and then the price started to take off, and our valuation was actually going up with it. Up to this point where it looked to us that this was fully valued at this point. And we started to pull back in terms of the valuation. And the price was starting to pull back. This is an interesting point here where you see that our valuation actually turned up again, but the price was continuing to fall. So one of the things to be aware of in fundamental valuation is, given the time frames that we're dealing with, this can happen where it looks, where if the market's going down, it doesn't matter if the stock is fundamentally undervalued, the stock is going down with the market, and the valuation will stay. It might come down slowly with it. It might stay. It might actually even go up based on the indicators, the calculations that we have in the valuation. But what this does is this gives you sort of a longer-term perspective on the valuation of a stock. So really more of a focus on buy and hold. If you're looking at a particular stock for a longer-term hold, what kind of evaluation are we getting on that? I've loaded a few different ones here. So Netflix, this is a really good example. Fundamentally, this always looks overvalued. That's really just the way it seems to be with Netflix. Amazon is another good example. You can see that even though the stock was rising, our valuation was consistently below it. So there's a series of stocks, those very high growth stocks, that fundamentally the future growth rates would have to be so high in order to get to the valuation at that point that we end up showing it as fundamentally undervalued. And that's fairly constant for people that are doing fundamental analysis. Those very high growth rate stocks, this is generally a profile that you will see. Something like Facebook, I've got a daily here on Facebook over the last few months. You can see it's jumping around a little bit. There's things going on in the valuation. But for the most part, we're showing that the valuation is holding above the value of Facebook, the price of Facebook, excuse me, as we're on a go-forward basis here. Got a few others, Johnson & Johnson as an example. JP Morgan, sort of a similar. So the large caps, you tend to see this where the price and the value tend to be very close. First Majestic, a large silver company. This is interesting. Our value was still staying higher as the price was falling. Gold and silver looked fundamentally undervalued for quite a period of time. And we see little spikes, and that's just the nature of those commodities, is we see those little spikes. Again, we're saying it looks like these are fundamentally undervalued. We've seen a move in gold, probably an over $100 move in gold in the last couple of months, and that's been pulling valuations up quite a bit in those companies. So that gives you an overview of what the indicator looks like. If you register on the site, on StockCalc, as I said, you will get the indicator. It requires your machine ID, but that then you can play around with the indicator and see what you're getting for valuations for the companies that you're looking at technically as well. So I will move back. There we go. I'll move back to the slides. So the questions. So Juanita, do we start with the questions now then, or what would you like to do?
Yeah, go ahead and take it away with your questions. You have about 7 or 8 minutes left.
Okay, thank you. So what I'll do is maybe I'll just read the note. YH asked, enterprise value, is that equal to the owner's equity? The enterprise value actually includes the owner's equity plus the debt. So in order to calculate the owner's equity, we would actually have enterprise value minus debt. So that's why I wanted to point out those two up front, because the enterprise value is the total value of the company. It's the value of the debt plus the value of the equity. And it's really the value of the equity that we're most interested in. The debt's important, of course, but for calculation purposes, it's the equity that we're ultimately trying to figure out. Robert, in order to plot your indicator on my NT charts, do I need to be able to pull fundamental data from my own data source, or does it pull the valuation from your site? I suspect it's from your site, but I want to be sure. Robert, you're correct. It pulls it from StockCalc, actually through our API. So we built an API for the NinjaTrader app, for the website, and that data comes directly from StockCalc. Robert also asked, do you have a market analyzer indicator so that I can list columnar data rather than using a chart in NT8? We have not built one. We've built the line to start with, but the data is available through the table. If you open up a table and scroll over the data, you can see the valuations that are live as well too. So if I do that right here, so you can see the StockCalc valuation here compared to the price data that's going on. Oh, I'm sorry. I need the screen share. My apologies. There, I'm back. Okay, so You can see the StockCalc valuation compared to the price data as I'm scrolling over. You can see how it's changing. Okay, move back to the slides and the questions. Where do you source your data? Good question. Actually, the raw data from our site comes through Morningstar. So every night we get a data feed from Morningstar, all the financial data that's new, the close price data from the previous day, the ratio data, and then all of our models get built on top of that data. So 2 o'clock, 3 o'clock in the morning, the servers are running, starting to run all of the valuations for those 7,800 companies. It doesn't take long to do the calculations, but we build HTML and PDF docs for all those 7,800 companies. We actually build 7,800 reports every night times 2, and that takes a few hours to generate because of the volume that we have. And Robert, thank you for the question. I appreciate it. Okay, any other questions from anyone else there? As I mentioned, and Juanita has put up the link. Wonderful. Thank you, Robert. Looking forward to it. You'll see our contact information on the site as well, too. I gladly provide demos if I can, just a matter of finding the common time for us. So once you sign up, send us a note, and we'll find a common time if you'd like to go in deeper. So we can go in and take a look at your stocks. I can show you how to load your portfolios or build portfolios on the fly in the site, that sort of thing. Okay, I will get rid of the data box, and great product, looking forward to trying it. Thank you, Dean, appreciate it. Looking forward to having you. Okay, Juanita, maybe I'll pass it back over to you then.
Sounds good. Thank you, Brian. I want to again thank Brian for joining us today for a great presentation. Everyone in attendance here will receive an on-demand recording of today's event, so please keep an eye out for that email. NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. If you find value in them, we do hope that you will attend them on a regular basis. We'd like to remind you that the information provided today was that of StockCalc and not of NinjaTraders. All information was for educational purposes and should not be construed as trading advice. Again, we do appreciate the time you spend with us. Enjoy the rest of your day, and we hope to see you in future webinars. For those of you who are interested in taking advantage of the 7-day trial that Brian pointed out, I'll leave the room open just for a moment so that you can go ahead and select on that hyperlink there that's posted in the room in blue, or I put it in the chat as well. Thank you again for everyone who attended. Happy trading from everyone here at the NinjaTrader Ecosystem. Have a great day.